Let's take a closer look at the energy sector and deals there with Lande Spottswood. She's partner M&A and capital markets at Vinson Elkins, and she has advised on more than $500 billion of M&A transactions with a focus on energy. And she joins us now for Premium Players. Lande, thank you so much for joining.
Thank you for having me, Dani. It's good to be here.
This is a sector that, again, you know extremely well. You've seen a lot, but this time around, it's oil prices that have been extremely volatile, jumping from above 100 on Brent to below. Well, what has that shift in volatility done to M&A markets?
I think the key, if I was trying to sum it all up in one phrase, volatility in energy M&A, practice has made perfect. We've had a lot of practice with volatility lately, and deal makers have gotten used to it, and they've started to move through it. I think that cash deals for upstream, you're just not going to see those get announced relatively soon. I think when there's an expectation we'll know more about the future strip 2 weeks from now than we do now, you're just not going to see people pull the trigger. But I do think talks are continuing. I think activity is going to continue, and volatility is the new normal.
Does it, though, make it difficult to agree on a price if the underlying commodity is moving around a lot?
It does, and particularly a cash price, right? And so if I was in Midland last week and talking to clients who are kind of pure play Permian producers, and they've seen a lot of assets get pulled that were in the market. We've seen that with processes we're working on, because it's just hard to agree what something's worth when you don't know what the price is going to be a year from now, 2 years from now. And you can just wait and see. If this continues the way it has, and there's just uncertainty about when the strait's going to reopen, I do think that deal activity will continue, because that's what all the macro is pointing towards.
And to your point, we're used to that. We know how to handle volatility. But if the net impact, even if this war were to resolve itself in a more timely fashion, there's been this expectation that oil and energy prices settle just at a higher rate because it takes a while to restart oil fields, that we know that there's this risk that exists. What change would that mean to see oil just structurally settle at a higher level from here?
I think that would be gangbusters for energy M&A. And I do think that's what we would expect if you see this resolved in the next month or so, without too much more long-term damage to assets in the Middle East. And so what you would see is prices reset, maybe closer to where they are now on the forward curve. And that would make energy companies healthier. It'd make them more willing to invest, stronger balance sheets, buyers more aggressive. And all the long-term macros towards consolidation.
So a lot of the oil majors, Exxon, Chevron, some of the shale producers like ConocoPhillips and Diamondback, they've done acquisitions. Have they fully digested those? Are you seeing the pipeline? Are they ready to come back for second bites?
This is a year where, yes, I think there was a lot of large-scale M&A that got held up too long in the FTC during the last year of the Biden administration. Those big deals are starting to be fully digested. And what people sometimes don't remember, if you're not in this space every day like I am with these energy companies, is they're in the business of selling their assets every day. And so you have to constantly be thinking about the next place to grow, or you're going to get smaller. And so I do think they're ready to do more deals if you can find the right one.
Yeah, to that point on the regulatory landscape, Scarlett was just talking about news coming from Semaphore that JetBlue was looking at maybe combining itself, different from your world, I realize, but it's a deal that they had attempted before and couldn't in the Biden administration. What has the regulatory landscape of having a more deals-friendly type of administration done to the energy patch?
I think we've seen it in two ways. One, I think it's a regulatory environment that is much more friendly towards development generally, the building of large-scale infrastructure in a way that the Biden administration wasn't. So I'm seeing clients deploy capital towards building big projects, big pipeline projects, big data centers that maybe isn't M&A exactly, but it's definitely, taking advantage of a different type of regulatory environment. On the antitrust side, I think there's two big differences. One, I think there was some just general political overlay that was negative for consolidation in the energy space. During the Biden administration, there was a lot of inflation concerns. People were focused on gasoline prices, and they weren't friendly.
Don't we still have that, though? Isn't this administration really concerned about gas prices and affordability?
Yes, but what I was going to say is it wasn't always deals that were going to actually impact gasoline prices that were being focused. We would see some natural gas combinations that, I think your viewers are sophisticated enough to know that natural gas mergers don't tend to impact gasoline prices, but it makes a good headline if you're trying to play politics. So we've seen less of that. There's not going to be that. And there's also just this administration, I think, has less sincere cynicism about scale generally. I think under Lina Khan, there was just this discomfort with big, even if there wasn't a clear competitive problem that could be pointed to in a deal. And I think there's less of that here. And I also think there's a desire to move faster in getting things through. So I do think it's a friendlier antitrust world to do large energy deals than it was 2 years ago.
Lande, this has been so fantastic. You have to come back and join us soon.
I would love to come back. Thanks for having me.
Really appreciate your time. That's Lande Spottswood, partner M&A and capital market at Vinson and Elkins.